All right, let's get into it. Today, we are going to demystify one of the most confusing, yet absolutely crucial, topics for any trader: choosing the right time frame.
So have you ever had this happen to you? You pull up a chart and on the daily view, it's screaming buy. I mean, everything looks perfect. But then you zoom into the 5-minute chart and it looks like a total disaster, heading straight down. So you're left wondering which one is real, which trend is actually telling the truth. This one single question is where so many traders get completely lost. And here it is, that exact conflict right in front of you. On the left, that 5-minute chart is just, it's chaos. It's a mess of sharp, unpredictable moves. This is what traders call market noise. But look at the right. For the very same asset, the daily chart shows this beautiful, clear, steady climb. It's the same market, but it's telling two completely different stories at the same time.
So, to solve this puzzle, here is our game plan. First, we're going to break down this time frame trap that catches so many people. Then, we'll cover the absolute basics, Timeframes 101. After that, we'll get personal and help you find a style that actually fits you. Then, and this is a big one, we'll uncover why looking at the bigger picture is often so much better. And finally, we'll tie it all together with the powerful multi-frame solution that the pros use every single day. Okay, let's start with this idea of the time frame trap. This is the core reason so many traders feel like they're driving with one foot on the gas and one on the brake. You're constantly getting these conflicting signals, and it's just plain confusing.
So now, let's jump into Timeframes 101. Before we can really fix the problem, we've got to make sure we're all speaking the same language. Let's get the foundation right.
Honestly, the easiest way to think about a time frame is like the zoom lens on a camera or maybe a microscope. Are you zoomed way in, looking at the market's every tiny little wiggle on a minute-by-minute basis? Or are you zoomed way out to see those grand, sweeping trends that play out over weeks or even months? Each and every one of those candlesticks you see is just a snapshot of all the price action that happened within that period you've chosen. And this is how it all connects. See, bigger time frames are literally built from the smaller ones. A single daily candle isn't just one thing that happens. No, it's the entire story of that day's trading. All the battles that were fought, all the drama on those 5-minute and hourly charts, all of it gets condensed and packed into that one single daily candle.
And that leads us to a really crucial point. You have to find your style. There is no secret, one-size-fits-all, best time frame out there. The right one is the one that fits your life, your schedule, your personality, not the other way around.
So this chart kind of maps out those different trading lifestyles. I mean, are you a scalper, someone who thrives on that super fast-paced action, glued to the 1-minute chart? Or maybe you're a position trader, making just a few big decisions a year based on weekly or even monthly charts. Just take a look and see which one of these feels most like you. Look, the bottom line is this: there is no right answer for everyone. The best time frame for you is the one that lets you trade without stress, the one that fits your schedule. If you find your trading style is making you anxious or forcing you to check your phone every 5 seconds, that's probably a huge sign that you're using the wrong lens.
All right, now for a really powerful and maybe even surprising idea. We're going to talk about why going bigger is often clearer. Let's make the case for how slowing down can actually speed up your progress as a trader. It sounds weird, I know, but stick with me.
And hey, don't just take my word for it. Justin Bennett, a trader with over 2 decades of experience, he puts it perfectly. He says, the daily charts are far easier to trade. Commit to them for 1 month, and I can all but guarantee you will find more reliable signals than ever before. That's a powerful statement. And here's exactly why that is. Lower time frames are just chaotic. They're full of that noise and those false alarms that trick you into making bad decisions and overtrading. But the higher time frames, they act like a filter. They cut through all that chaos to reveal the true underlying trend. It helps you trade the real signal, not all the distracting noise. So what's the secret ingredient here? It's one word: liquidity. Think of it like this. A small rowboat in the ocean gets tossed around by every little wave, but a giant cruise ship, it just cuts right through them. That cruise ship is like a market with high volume and high liquidity. The more trading volume there is, like in a full 24-hour candle, the steadier the market is and the more reliably it respects those key technical levels. But this is where a huge myth comes in. I hear it all the time. I can't trade daily charts. I don't have a big enough account for those huge stop losses. Well, let's just bust that myth right here, right now. Here's the fact. A wider stop does not mean more risk. It just doesn't. You are always in control of your risk. All you do is adjust your position size. You can risk the exact same amount of money, say $100, on a trade, whether your stop loss is 10 pips away or 100 pips away. The only thing that changes is how big of a position you take.
Okay, now let's bring it all home. This is where we put all the pieces together with what I call the multi-frame solution. This is how you can start to see the market with the same kind of clarity that a professional trader does.
So here's the secret. The pros don't just pick one time frame and stick with it. No way. They use several of them, all working together in harmony to build a complete, three-dimensional picture of the market. This technique is called multi-timeframe analysis, or MTFA, and it is the key to finally escaping that timeframe trap.
And the process is actually pretty simple. It's just 3 steps. Step 1, use a long-term chart, like the daily or weekly, to figure out the main trend. Think of this as the river's current. Which way is it flowing? Step 2, zoom in a bit to a medium-term chart, maybe the 4-hour, to find a specific trading opportunity that's flowing with that current. And finally, step 3, use a short-term chart, like the 1-hour, to time your entry with absolute precision.
Let's look at a real-world example of this in action. A trader sees a super strong buy signal on the monthly chart, right at a major price level. Okay, so that sets the big picture direction. They know they want to be a buyer. Then, they move down to the daily chart and patiently wait for a little dip, a chance to get in at a better price. Finally, the actual entry was timed on an even smaller chart, which perfectly aligned that short-term move with the massive long-term trend. It's beautiful when it comes together.
But you know, this whole approach gives you more than just a technical edge. The real magic is that it gives you a psychological one. It gives you a plan, a structure. It forces you to be patient, and it helps you completely ignore all that market noise that causes so many other traders to panic. It's really about trading with clarity and, most importantly, with confidence.
So, I'll leave you with this one final question to think about. After everything we've talked about today, are you absolutely sure you're looking at the market through the right lens?